This video is entitled Time Value of Money, Internal Rate of Return, and is number 4 in my Financial Calculations review series. I'm Dr. Renaud from Shawnee State University, and I'll be taking you through this very brief video presentation. Internal Rate of Return. Internal rate of return is trying to calculate the interest rate or the rate of growth or the rate of return on an investment based upon the cash flows of that investment. Okay, that's really kind of handy. If you're comparing two different investments, you may want to calculate the internal rate of return of one investment versus the internal rate of return of another investment. The investment with the higher internal rate of return, well, is a better investment. It's returning a higher rate. So what we do is we calculate the net cash flow, found in Review 3, of the expenses, and we calculate the net cash flow of the income and find the interest rate where those two are the same. Now that's a little difficult to do because look at the formula to do that. We have to calculate one and subtract the other and try to get them to zero, but as we reduce the, it gets to be a difficult calculation to do, internal rate of return, manually by hand. So we're going to do our internal rate of return calculation here using spreadsheets and using programs. So let's analyze the following investment. $100,000 today to buy into this investment. Maybe it's a project we're doing and it's going to cost us $100,000 to do the project. Or maybe it's building a new factory, or maybe it's investing in a new product, or maybe it's investing in a new company or a new technology. But it's some kind of an investment. We're spending $100,000 today, which means that our present value of our expense is going to be $100,000. That makes sense. So our expense side of our calculation is very easy. Now our expense calculation could be much more difficult because what if it was spend this much this year, this much the following year, and this much in another year to get these cash flows back on the other side. Our net cash flow, of the expense could be complex, but in this example, the net cash flow of the expense is rather simple. Now, let's come over and look at our income side. So, at the end of year 1, we expect to have made 20 grand from it. In the end of year 2, we expect to make an additional 30 grand. In the end of year 3, we 40 grand. And at the end of year 4, we expect this investment to return $50,000 to us. So we're expecting this investment to give us a return of $140,000 from our original $100,000 investment. That sounds like a pretty good deal. So I calculate using my spreadsheet all of our present values, and then I calculate the difference between the two, and then I use goal seeking within my spreadsheet to calculate the internal rate of return of 12.8%. Let me show you the details of that on the next slide. So here you can see I calculate the present value of all of the expenses. Now we only have expenses in year 0, but we could have had expenses in year 1, 2, 3, and 4 that we would need to calculate the present value for, and we would then have our sum of the present values of the expenses. You also see our incomes and then our present value of incomes all being calculated using the same interest rate, which is the rate in cell D1, which is going to be our internal rate of return. And we then calculate the difference between the income minus the expenses in cell 9, in cell D9. So I then go into my spreadsheet and go to the goal seek function. I'm currently using a spreadsheet called LibreOffice, but there is a goal-seeking function in Excel and in all the other spreadsheets I've ever worked with, and they all work basically the same. So what I do is, in the goal-seek window, once it comes up, I tell it the cell that contains the formula. So the last formula, the formula I want to be equal to 0, the difference, I want to be 0 is in cell D9, and I tell it I want that to be targeted at 0. Find the internal rate of return where the present value of the expenses equal the present value of the incomes. That's how we calculate internal rate of return. Remember second slide. So I then put in the formula cell the target value, and then I say, well, the variable cell is the interest rate, and that's in cell D1. So we're going to find the internal rate of return. And when you hit OK, you'll watch your spreadsheet think for a few seconds or a fraction of a second, and it will tell you the correct answer. It'll calculate that internal rate of return. This spreadsheet, or a spreadsheet very similar, is extremely handy when you're comparing two different investments with different incomes and expenses at different times to try to figure out which one is the best use of your money to invest in, or which one's going to give you a higher return. Now, here is a Python program to do the same thing. Notice that PV is the function we created in Review 2. NCF is the function we created in Review 3. The rest of the code does something called Newton's method, which basically takes a high and a low value, picks the value in the middle, and then moves up to the range or below the range to figure out and to kind of hone in on the right answer. So you can see that it started with an internal rate of return at 0, but the difference was $40,000. Well, that's not going to work. It then went to an internal rate of return of 50%. That's too big. It then went to an internal rate of return of 25%. That's too big. It went to an internal rate of return of 12.5%. That's too small. So it then kept cutting the difference between those two until it finally honed in on the right answer at 12.82% as the right answer, as the best answer for this internal rate of return. The great thing about this program is all you have to do is change the values there on the line where it calculates the difference by calling the net cash flow function, and this will find the internal rate of return for virtually any sequence of incomes and outcomes. This Newton's method, just to kind of tell you a little bit about it, because it's a really cool technique used in lots of different computer programs and lots of different algorithms. The idea is, well, imagine, have you ever played the game with a friend? I'm thinking of a number between 1 and 100, and I'll tell you higher and lower when you make your guess. Well, I don't know if you've learned, but the first guess is always 50, because that cuts the search space exactly in half. You either know that it's above 50 or you know it's below 50. So you've eliminated half of the numbers. And the next time around, you say either 25 if they say lower, or you say 75 if they say higher, because that then eliminates half of the search space. And instead of searching 100 numbers, you're now only searching in 25 numbers. Then you say, you cut the search space in half every time. And that's what this little algorithm, what this little program is doing. So take a moment and look at this program and try to figure out how it's working, and take a good look at it, because I think it's a really kind of a neat idea and a good way to use Python to very quickly calculate your internal rate of return on a list of cash flows. This concludes the video on internal rate of return as part of our time value of money series. Please, if you see the entire series, check out the videos prior to this one, because it all builds upon each other. Like or subscribe if you find this helpful. I'd really appreciate the thumbs up. You can always contact me at jrenault@shawnee.edu if you have any questions. Remember, this video is copyright 2022 by James M. Renault, PhD. All rights are reserved under copyright law. And again, thank you for watching.